A few weeks ago, I was sitting in front of my computer looking at a $30,000 hole in my portfolio. I had lost $16,000 in February and $14,000 in March. As a matter of fact, if you look at my loss between 28th February to March 30th, I had lost $41,000 at one point, nearly all of my year's gain. The AI disruption and Iran Israel war were in full swing, and it felt like the great rotation into growth was the biggest mistake of my life. But the truth is, market did not lose this money for me. The loss came from a series of high stakes mistakes that did not go as planned. I'm going to walk you through exactly what I did and what my portfolio looks like right now. I would also show you what stocks I have bought past couple of months and what stocks I am going to buy in the month of April. More importantly, I am going to show you what strategy I am applying to reach my $1 million goal. So let's dive right in. Okay, so before we move any further, I want to remind you that I am not a financial advisor. All the information, data, and opinions presented in this video are for entertainment and educational purposes only. I have been investing in the US stock market since March 2025. As an expat living in the UAE, I have a specific strategy built around my tax situation. I pay zero capital gain tax, but I pay 30% dividend tax. So, for example, if you look at my Microsoft Corporation position, Microsoft is currently paying 0.86% dividend. And if you look at my yield on cost, that is 0.6%. Although my cost per share, which is $422, and Microsoft is also trading at $424, which is around the same. So dividend yield should also match, but due to 30% tax, it actually is reduced to 0.6% only. So this is the exact reason why I initially prioritized dividend heavy stocks like Coca-Cola, Occidental Petroleum, SCHD, Coterra, UPS, Chubb, Procter and Gamble and Vichy Properties. If you look at my portfolio weight before February, I had a lot of dividend heavy stocks and a lot less those growth stocks. But after February, I quickly switched to tech stocks, growth heavy stocks. This was actually a deliberate choice because tech stock valuations were a lot higher at that time and I was waiting for them to cool down. When the broader market started to wobble and fear set in, I saw my entry point. I bought more Microsoft, Amazon, Meta, Uber, and Nvidia. It was a strategic move to rotate my capital to growth stocks. Take Microsoft as a prime example of this timing blunder. When it dipped from $480 to around $435, I jumped in aggressively, buying a significant chunk of shares in $420 to $440 range. As you can see on the purchase history graph, I was chasing the dip. I did manage to snag in a few shares under $400, which helped, but the damage was done. Right now, even though Microsoft has been rallying for the past couple of weeks, I'm still struggling to break even in this position. I am okay with the long term conviction, but I clearly could have executed the entry better. So the problem was not just the rotation itself, it was the timing and the sheer speed of the downturn. Despite my conviction, software stock was very volatile because Anthropic has launched multiple agents to target the software sector. As you can see from this tree map, Microsoft was my biggest position and it was hit the hardest. I was holding an option of the Microsoft and the Microsoft stock itself. And I was down around $14,000 alone in the Microsoft itself. I was also holding Duolingo, which was also down around $2,300. So, this brings me to the third and the most fundamental mistake, concentration risk. While I believe in the long term potential of the Mac 7, my rotation in the Mac 7 was executed so aggressively that I had created an extreme imbalance. If you look at this chart, you can clearly see that I was invested 75% of my portfolio into the Mag 7, and the remaining 25% was spread thinly across everything else. To visualize just how granular the problem was, let's look at this tree map. From my tracking sheet, this chart highlights the specific weight of each individual stock. You can clearly see how massive the blocks of Microsoft, Amazon, Nvidia, Apple, Meta, Google, and S&P 500 are compared to everything else. So when market decided to punish the software sector, I was overly exposed to it, and the impact was fourfold. As you can see from this graph, from January 30th to March 30th, everything was down. People ask me how I stayed calm. I was down $41,000 at that point. The earnings of the Microsoft and all the other Mag 7 were very strong, fundamentals were very strong, and this was just a sentimental failure. The Iran US tensions, SaaSpocolypse headlines were temporary. The move toward AI infrastructure was permanent. So in March and February, I had deposited $18,000 more, and I doubled down on some of the oldest positions like Microsoft and Meta, and I bought a new position in Visa as well. So if I show you my dynamics of portfolio returns again, as you can see from April 2026, I'm up $46,000. Now I have recouped all of my losses in February and March, and I'm up actually more than that. So my positions is Microsoft, Amazon, Meta, and all the other stocks. They are not down anymore. If I just click on all, as you can see, Amazon is up $7,800. Apple is up, Nvidia is up, S&P 500, Google, and even the Microsoft option, and all the other stocks are up. So let's compare it to the S&P 500. And if we click on all and select S&P 500 here, as you can see that my all-time performance, I am up 11% and comfortably beating S&P 500. So let's look at the other timelines in 1 year, year to date, and in all the other time durations, I am beating the S&P 500. I was down quite a lot at this point, but I have gone up quite a lot. So what's next? After a massive $46,000 rally, most people would double down on tech. I am doing the opposite. I am going into the defensive stocks like Coca-Cola, Procter and Gamble, and other defensive stocks. If you look at my dashboard, I have been holding $251,000 portfolio now, and I have booked some profit, and I'm holding a cash position of $13,000. My time weighted return is around 42%, and I am up around 30% with a profit of $58,000. If you look at my diversification chart, you can see that I am way big up on tech stocks, and I'm trying to wind them down and move into the defensive stocks now. So let's take a look at my $1 million goal. If we just plug in $1 million here, and I am going to achieve it in the next 10 years, and my monthly contributions would be around $800, and I am expecting around 12%. This 42% time weighted return is not achievable, I know, and let's calculate it. So this calculator say that I can achieve this by 2036, which is around in 11 years. And it has actually created two alternate scenarios. This safe scenario says that I can achieve it in 2039, and it is also considering the inflation. And this alternate scenario has reduced 1 year, but it has actually increased the return to 15%. And then I can achieve it in 2036. So from a $41,000 loss to a $46,000 gain. This is the reality of a growth investor. So I want to hear from you. Have you ever held yourself through a massive drawdown like this? What are your thoughts on my rotation back into the defensive stocks? Drop your questions in the comments. I'll be answering as many as I can. If you found this update helpful, please hit like and subscribe. It really helps the channel and keeps me motivated to share these raw numbers with you. Let's hit that 1 million goal together, and I'll see you in the next update. Thanks.